rate hikes to drive up mortgage repayments. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because rate hikes are now being discussed, and there's concerns, that mortgage repayment rates could be on the way up, and there's a bit of concern and fear coming out in the media about that. Now, before we go through this and discuss a few things, I want to have a word from our sponsor, who, at the moment, is our very own Twitch show, Freedom Friday at 7:30 p.m. live on Twitch. Check it out. We have another show on Monday night as well with Rachel and I, where we discuss various things. So make sure you have a look at that. So, the current cash rate, it's sitting at 0.1%. 3% used to be considered an emergency rate, everyone. It used to be considered an emergency rate, 3%. So there's room to move. So there was concern of potentially going negative. But our very own Reserve Bank governor has clearly said that it isn't really worth it. Because people actually save more. It causes a loss in their savings, so people throw more money into their bank accounts. It doesn't actually have the effect of spurring economic activity. And I think it would also damage consumer confidence. Plus, we've heard from viewers over in Europe who run businesses and who need to have a float of money in their businesses and incur thousands of dollars every year just in negative interest. It's something we want to avoid. Our fiat is already losing money as it is through inflation. Do we need the added help of a negative interest rate? So let's look at the rate predictor from the ASX. And it's predicting, to decrease to 0% of 98% and no change at 2%. The RBA has said then they don't intend, or they did say, they don't intend to change rates until 2024. We'll have to see if it lasts that long. Many people, including myself, have locked in our mortgage for 4 years. So it could be just when that 4 years expires, boom, we all suddenly get hit with a rate increase. Now, the notes from the latest monetary policy decision, which just happened yesterday, or were released yesterday. The Reserve Bank Board met this morning by video conference. At the meeting, we agreed on policy measures that will provide ongoing and important support to the Australian economy as it continues to recover. In particular, they decided to retain the April 2024 bond as the bond for yield target and retain the target of 10 basis points. Continue purchasing government bonds after the completion of the current bond purchase program in early September. We will purchase $4 billion of bonds a week until at least mid-November and maintain the cash rate target at 10 basis points and the interest rate on exchange settlement balances of 0%. So they haven't made any changes. But that isn't stopping concern appearing more and more in the media that rate hikes are going to manifest, and we'll see people have to pay additional mortgage repayments. Now, should we be worried about this? Because remember, we were talking about it before in the past. Last year, there was all these predictions of interest rate hikes. Well, no, not just interest rate hikes. There's predictions, of property falling. 40% modeling by the RBA. The banks were predicting up to 30%, 10%, 5%. And then, of course, we had government intervention. And we had mortgage holidays. There were articles from the ABC where you had people who were professionals but had borrowed to the hilt or was just, frankly, so bad at managing their money that they needed to depend on these mortgage holidays to get by. They were thankful for it. Now, the question is, was this painted by the media to create a narrative so there'd be sufficient political will to allow the government to incur more debt than has ever been incurred before and to throw more money at housing and different parts of the economy? That's the question there. We didn't see a flood of properties hit the market. If anything, property has started to go back up. Now we'll have to see if the potential of a mortgage rate rise, could hit mortgage repayments, because there's a few things we want to look at. I mean, if we have a look here, this is loans in negative equity, and they're trending down to where they were. Of course, if property falls, what else could the government do? This is one here, prepayments. Have a look at how far people are ahead on their mortgage repayments. A lot of people are ahead. And even if your repayments, go up, you've got your prepayments to fall onto. You can adjust your budgets. You can find ways. Houses also have liquidity buffers. Even renters, indebted homeowners, 4 months of liquidity set aside. And then finally, you've got here the household liquidity and debts. You can see just mortgage prepayments. You can see the deposits that people have. So even if there is a rate rise that goes up and drives up mortgage repayments, even if we see a 1% increase in interest rates, maybe 2%, is that going to affect people, or will they have enough of a buffer to work it out? It may have an effect on consumer spending, but could it see a flood of property go to the market as people are forced to sell? That's the question I put to you. Because there'll be some people who'll be hoping that. There are people out there that are hoping for a massive property price correction here in Australia. And we need it to remove the perverse incentive to just constantly invest in property as the only way to get ahead. But I can't see the political will to allow that to happen. If anything, we've seen the lengths that our politicians will go to ensure a continuation of the status quo. So, homeowners could face a rise in mortgage repayments of hundreds of dollars a month within 2 years, with the big banks predicting cash rate hikes well ahead of the Reserve Bank's forecast. And it depends. It depends. I think the biggest people at risk are the ones who recently jumped in and went to the hilt, went right to the edge of their capacity. Now, we'll have to see how many examples of that there are. There's a bit of fear in the media that the banks are just letting anyone borrow willy-nilly, but I don't quite see that happening. I think that's a bit of fear. It's the same thing that the ABC, every single one of their articles, they never actually hold the person to account for not having an emergency fund and not preparing for dire situations. It's always someone else's fault. It's always a sob story. I mean, you've got a professional couple that were dependent on the good graces of the bank to give them a mortgage holiday. That's a bit concerning. Borrowers would face an average variable mortgage rate of over 4.3% from as early as 2023, new modelling shows, if recent forecasts for the cash rate to hit 1.25% are reached. Now, here's the thing. That also means you might actually start earning some money on your deposits. Wouldn't that be a novel concept, having your money sitting in the bank and actually getting something for it? You got the number of hoops you have to jump through to get pathetic deposits. I think I'm getting 1.35 on my ING. I've done the Rabobank introductory rate. Now ING, I've got to jump through all these hoops, and it's capped at just 100 grand. Anything over that 100 grand, you've got to put in another account where I think you get 0.75. Everything below inflation. So awesome, isn't it? Be nice to actually just sit there and have your money, earn your money doing nothing. Wow, that'd be a novel concept. See, that's what previous generations had. They had that. They had that. Put money in a bank and it just earns you money. Imagine, no risk, virtually no risk. While the Reserve Bank is expected to keep the cash rate on hold at the record low of 0.1% at its Tuesday meeting, and it did, until 2024, several of the big banks are forecasting hikes before that from as early as next year. And both Commonwealth Bank and Westpac expect the rate to hit 1.25 in the third quarter of 2023 and 2024, respectively. Such a peak would pale in comparison to the 17.5% seen in 1990, and only bring the cash rate back to June 2019 levels, but would be enough to add hundreds of dollars to monthly mortgage repayments and slow down housing demand, experts say. Modelling from financial comparison website Canstar shows the average variable mortgage rate would lift from 3.21% to 4.36% based on the current margin between the two rates. A homeowner who took out a $500,000 loan tomorrow would face their repayments jump by about $300 per month from $2,464 if the cash rate hit 1.25% in 2024. That's despite reducing their remaining loan to $468,770 after 3 years of repayments, and assuming the bank only adds on the cash rate increase. Yeah, that's what happens. But you'll also be able to earn money on your deposits. I mean, $300 per month should be manageable, you'd hope. You would hope. And a $500,000 loan, I would say, is not extremely excessive. CanStar Group Executive of Financial Services, Steve Mickenbecker, said homeowners should be looking to get ahead on their repayments. Now, if they could afford to, because it would only become harder to pay off their principal in the future. Well, that's very good advice. And we're seeing this. We're seeing this here. The people are already ahead on their home loans. So I think in some ways it's just more evidence of the divide between those that are in the market and those that are doing well and those that are not. Those are right at the edge. I think the most at-risk people are going to be those that just jumped in, that barely scraped in, and are at risk. Maybe some of these 2% deposit people that the government let get in, or the 5% deposit people. Don't worry, guys. Then they'll pull out Mortgage Keeper, and that's meant to be a joke. While the forecast cycle may see a modest increase to a peak of 1.25, rates were likely to rise in the years that follow, he said. Separate CanStar modeling shows average variable loan rates could reach more than 7% in the future if the 10-year bond yield returns to levels consistent with nominal gross domestic product growth of about 5%, as assumed in the federal government's recent intergenerational report. Bond yields are currently about 1.5%. Well, this will be interesting. This will be interesting if your mortgages went up a decent amount. Are you able to cop it? I mean, the modeling from the bank for people getting the loans should anticipate an increase of the interest rates. I mean, for us, we wouldn't even be able to get a loan anymore from the bank, I don't think, because we've got so many children. So while we can easily pay the mortgage that we have, and we're a significant portion ahead of it, we couldn't get another one. Because apparently kids cost a lot of money, which is funny. But if it went up, you just have to adjust your lifestyle. Now's the time to be building that war chest, everyone, to be paying ahead and finding places where you can earn a passive income one way or another. So if, for instance, the average variable loan rate hit 7.04% in 2031, as it did in 2011, that same borrower who took out a $500,000 loan would pay about $900 more in monthly repayments than they do now, even after a decade of repayments. That's why you got to get ahead. Mr. Mickenbecker said borrowing costs for fixed-rate loans were already rising and noted rising repayments could stress some buyers with larger loans. High levels of household debt would limit the tightening cycle, Westpac chief economist Bill Evans noted when predicting cash rate hikes from 2023 and a peak of 1.25% in 2024. The peak in the cycle was likely to be determined by the household sector's sensitivity to rising rates, given Australia's high level of household debt, he said. Well, it could be like in the US, where they tried to normalise. What happened? Didn't work. Meanwhile, CBA expects interest payments as a proportion of disposable income to return to the recent average, lifting from 3.1% to about 5%. Bank senior economist Belinda Allen said the rise to a neutral cash rate should not affect consumer spending, but it would be felt by individual borrowers, particularly those in the early stages of repayments, and could slow housing demand. For 1/3 of Australians with a mortgage, their interest rates will lift. This will obviously see people have to put more of their disposable income away, but to not the levels that should hinder their ability to spend, Ms. Allen said. The move to higher interest rates would be slowed by the large number of fixed-rate mortgages written over the past year, Ms. Allen said, and the fact that those on variable rates have built significant buffers, such as offset accounts and redraws. as well as other savings, which increased during the pandemic. An expected rise in wages growth would also limit the impact of rate rises. However, Ms. Allen stressed that looking at debt serviceability levels would be crucial when determining the cash rate. Rising rates would also see housing market activity slow, Ms. Allen added, noting recent increases in fixed-rate mortgage rates could take some of the heat off the property market, reducing the need for macroprudential measures to be reintroduced. Some banks have also lifted the floor interest rates at which new loans are tested, she said, which could start to reduce how much house hunters could borrow. Most borrowers don't borrow at their full capacity anyway. It may impact at the margin, but it's more just a signal that people need to expect rates to rise, Ms. Allen said. She described it as another developing headwind for the housing market, but said it would take more than that to see a significant change in activity given the strong ongoing growth in lending. Mr. Mickenbacker said borrowers should consider fixing all or part of their home loan and choose a flexible loan that provides flexibility to make additional repayments. He added they should make the most of low rates while they last, not settling for the average, with more than 190 loans currently offering rates below 2%. And, well, there you go, everyone. I mean, have you managed to secure your loan below 2%? We were talking to an AB yesterday, and she beat us. She got 1.97%. She was quite happy that she got a better deal than we did. We got 1.99. Now, what's the solution to this? I'm going to sound like a broken record because we need to get off our housing addiction here in Australia. Is it even possible? Is it even possible? You tell me. As always, thanks for watching. Like, share, subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can sign up for YouTube or Patreon. Support us by using SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy our merch from HeiseSays. Use Gold Pass from the Perth Mint or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time. Bye for now.